Hey everybody, I'm just going to answer a quick question here. This is Kevin, a CPA that does financial planning, and today I'm going to talk about the inverted yield curve. What does it mean? Is it bad? Everybody says it's bad, so it must be. So that's the question. We've been getting it a lot, and so I just want to go over the very basics of a yield curve, I promise, very quickly. So a yield curve has to do with the time period. A 3-month If you loan your money to the government for 3 months, that's called a 3-month T-bill. This is what the return was back in 2013. You got almost no return to loan it to the government for 3 months. If you loaned it to the government for 30 years, that's called a treasury bond, you got almost a 4% return. And so you see here the yield curve looks like a yield curve. Now in 2018, November, this was last month, here's what the yield curve looked like. It's called flat. And so all inverted means is that the 3-month is higher than the 10-year. That's all it is. This is higher than the 10-year, and that predicts really bad things. So that's part one. Now let's actually look at a chart that came from the Wall Street Journal that was supposedly predicting really bad things. And so this is a history of recession warnings, the inverted yield curve, and it's from Refined TV. So what does this say? Well, I'll tell you what it says in a second, but I'm going to go over what we know and what we don't know with the inverted yield curve. You see all these articles that we see, they have a headline that says yield curve inverting, dire warning, yield curve, and they always say stormy clouds ahead and all kinds of stuff like this. Okay, so what are they basing this on, and what still don't we know? Well, this is a history of recession warnings of the inverted yield curve, 3-month, 10-year. Again, you don't have to know what it is. But let's look at the evidence. There's two pieces of evidence here. Number one is, does it predict a stock market downturn in the next 12 months? Number two is, does it predict a recession? So right here, S&P 500 performance over next 12 months, and then over here is months until recession. The first thing to notice is there's only 9 times when this has happened, 9 times. So we're basing predictions on an N of 9 or a sample set of 9. I'm sure statisticians wouldn't like this, but anyway, this is what the data is. January 12th, 1966, the yield curve inverted. Oh my gosh, what happened? Well, the market did go down, S&P 500, 9.3%, but it was a false alarm for a recession. There was no recession. Just a number of months later, about 9 months later, once again the yield curve inverted. Stock market went on a tear, 24.3% increase over the next year. So you might want to have sold here and then I guess bought in September. That's hard to do. Once again, a false alarm for a recession. The next two are really fit what you see in these news headlines. December 19th, 1968. What we see here is a negative stock market return, double digit. We see a recession within 12 months. Boy, that really fits. February 1973, again, negative 21.6% return, and the recession showed up 9 months later. If all of them look like this, I would say, okay, this is, it's only 9, but it sure is scary. July 4th, 1978. 7.7% return. Now, that's not the greatest return in the world, but it is positive. In 18 months, a year and a half later, there was a recession. 1980, September, just as good to hold your money in a mattress as it was in the markets, and a recession did show up 11 months later. Next 3 are super interesting now. Here's where we get into the cloudiness of this as a predictor. May 29th, 1989, 12.2%. Great return. 14 months later, a recession did show up. Then September 10th, 1998, 37.71%. Bam! You would have missed that big return, and the recession didn't show up for 2.5 years. So can you really say that one predicted the other? I don't know. It could be correlation, not causation. And then February 20th, 2006, once again, double-digit return. Recession showed up 22 months later. So here's the main thing to take away. First of all, GDP, a negative GDP growth 2 quarters in a row is a recession. Does the market always bottom at some point during or after the recession? No. Sometimes it comes before, sometimes the market comes after. And as you can see here, once again, not a fantastic predictor of both. And then number two, if you're a long-term investor, do these small bumps in the road matter anyway? I mean, that would be the argument that we would make about, using anything to make a prediction is in the long run, things will probably work out well. There's no guarantee, but it's, based on history, it's pretty doggone good that you're probably going to get okay returns unless the world goes bankrupt if you're worldwide diversified. So thanks so much for watching. Again, Kevin, a CPA that does financial planning. Thank you.